Hello traders and welcome to another video from Berries. As you must have seen in the news and also in your portfolio if you are investor in Infosys, that Infosys corrected by 8.5-9% on Friday owing to bad revenue guidance. What does revenue guidance mean? Well, the management tells the investors what kind of growth it expects in the coming time. And earlier FY24 guidance was 4 to 7% and it has been revised down to 1 to 3.5%. So straight up 50% cut in revenue guidance, whether you take the upper band or lower. If you take upper band, it's 50%. If you take lower band, well, it's much worse. So this is the reason that market corrected so much in Infosys, and the result of Infosys sort of triggered a sell in entire IT pack, bar a few stocks here and there, and rest of the market as well. So that is the reason why the Infosys corrected, but that can't be the only thing, right? I mean, why does market correct so much when a company performs poorly, when it does not post that sort of revenues and so on? I mean, it's going to make money, right? Infosys is one of the largest companies in the country, and it's unlikely that it will ever go bust. It will ever decrease its revenue significantly from where it is today. So why does market react so violently? Well, for that we first have to get a refresher on our PE ratios. What are PE ratios? Well, price in the numerator of the current market price in the numerator, and either past 12 months EPS or the forward 12 month EPS. Forward 12 month can be projected by a number of methods. We will talk about that sometime in the future. Or past 12, whichever one you are comfortable with, whichever one your valuation system uses, you can use that. But there is sometimes quite a lot of difference in PE ratios of two companies, and you can see one example here. These are the numbers from Friday's trading session. So ICICI Prudential trades at a PE ratio of roughly 92, that is a historical PE ratio of 92. LIC trades at a historical PE ratio of 11. Why is there a difference of 8x here almost? And the reason for that is LIC is considered a government run company. It is a government run company, and that comes with a lot of inefficiencies in terms of administrations, in terms of costs, in terms of policies, because naturally government looks at the interest of citizenry before the interest of shareholders, and that is how a lot of decision making process happens in company like LIC. And we have seen this time and time and again in other sectors: power generation, power distribution, other utilities, mining, oil, coal, you name it, and this sort of administration policies have been in effect. So naturally investors don't want to pay too much for a company which does not always think of them first. Compare that to ICICI Prudential, run by two strong names. ICICI, which is one of the largest banks in the country, growing at a very fast rate, have a very good balance sheet now after some debacle past few years in the history. And Prudential is one of the largest insurance group in the world. Coming together, they have formed this company. It runs, it's a listed company, so it naturally comes with a lot of checks and balances. The two parent groups who run this company also have a lot of interest in growing it at a very fast rate. They push their products through different channels. ICICI Bank being one of the largest ones, which is opening a branch in every major city, every major town. It's going down to the large village levels also now, and through that they can very aggressively push ICICI Prudential products. And of course they have a much lower cost structure as compared to a government owned enterprise like LIC. Owing to all that, ICICI Prudential has the potential to grow at a much faster rate than LIC, and this is why ICICI Prudential gets a much higher PE at 92. But this is all narrative. How do we quantify this? How do we really know that growth that LIC says will happen in their stock or their company and the growth that ICICI Prudential says that will happen in their company is even comparable? Because if the PE was same, it was a very easy pick, right? If LIC was trading at 90 PE, it would have been an easy pick to go for ICICI Prudential for higher growth potential. But here PEs are also different. How do we compare? Well, before let me go to PEG, but before that, let me reiterate that value of a stock today is roughly equal to present value of its future earnings, and these future earnings can be for 5-year period, 10-year period, 15-year period, depending upon your investment horizon. larger the better, because then the company has the time to come over the cyclicalities in revenue, maybe a recession here and there, and all that will be taken care of, and you'll still have a long enough time period for company to grow. So this is something to keep in mind. And naturally, if a company grows faster, its future expected earnings are higher and its value of the stock today is also higher. And for that, we have a ratio which is called PEG ratio, which is now getting quite a bit popular in investing community. Generally, value investors say that lower the PE, the better. And that is precisely why I have taken this example, because here you have one company which trades at PE of 35, another which trades at PE of 15. So naturally, value investors will say we will invest in company 2 because it trades at much lower PE, and hence it is a better value pick. But if you see the growth expectations in company 1, they are 25%, whereas company 2, they are only 7.5%, roughly the GDP of India, rather GDP growth rate of India. And when you take the ratio of these, PEG ratio to be specific, 1.4 for company 1 and 2 for company 2. So a PEG ratio which is generally better if you have the smaller ratio. In that case, it turns out that company 2 is in fact the expensive one, because you are paying quite a lot more for lower growth where as compared to company 1. So this is where the sort of dichotomy in PEG ratio comes, that prima facie you might feel that a company is cheaper based on PE, but when you factor in the growth, the whole story changes, and which is why you will see a lot of new age companies trading at absurd P's like 140, 150, 200, and that's what the investors expectations are, that the companies will double their revenues pretty much every year or every 6 months, also in certain cases, looking at the PE ratios. Generally in the investing world, PEG of less than 1 is considered good. 1.5 is still okay, anything above 1.5 is considered really expensive. But in the emerging markets like India, most of the companies with healthy balance sheets and a good stream of revenue, a good growth in revenues and so on, with clean management, you will not find them at PEG less than 1. You will mostly find them at PEG between 1.5 and 3, depending upon the cycle of the market. Infosys currently looking at this roughly 4% revenue guidance, trades at about 20 to 15, 14 PEG ratio, so quite expensive there. But yeah, this is the reason why Infosys corrected so much, and why companies correct so much when they reduce their growth guidance, because every year they spend without the growth, the earnings in the future reduce, and in case of Infosys, they have sort of signaled that their cost going forward, at least for a few years, are not going to decrease drastically. So they have a definite trouble in growing their revenues when their clients are also putting their new projects on hold and so on. So this was the reason why Infosys corrected so much. PEG ratio is a very, very powerful tool when you are looking at sector as a whole to compare the company that will that gives you the best bang for buck in terms of value, in terms of growth. So make sure you use this in your valuation toolkit next time and in your decision making framework. Thanks for watching.